Let me ask you something controversial. What if everything you have been told about risk is completely wrong? Most people think risk is the enemy. They see it as a threat to their hard-earned money. They believe the safest strategy is to keep cash in a savings account or stick to fixed deposits. But here is the truth that wealthy investors do not want you to know. Risk is not your enemy, it's your most powerful friend in building wealth. I am Aparajita.mishra, a mutual fund distributor with over 6 years in banking and financial services, and today I am going to completely change how you think about risk in investing. If you are tired of seeing your money lose value to inflation, and if you want to understand how smart investors think differently, then this video is for you. Let's dive in. Here is a provocative statement that might upset some people. Avoiding risk is the riskiest financial decision you can make. Let me explain with a real example. Your grandfather probably told you that fixed deposits are safe, and technically he was not wrong. Your principal is protected, but here is what he did not tell you and the hidden risk nobody talks about. Let's say you put 10 lakh rupees in a fixed deposit earning 6% per year. Sounds safe, right? But inflation is running at 6 to 7% annually. After taxes on your fixed deposit interest, you are actually losing purchasing power every single year. That 10 lakh rupees won't buy you what 10 lakh rupees bought you 5 years ago. Your money is safe on paper, but it's slowly dying in real value. This is called inflation risk, and it's the silent killer of wealth. People avoid equity markets because they fear losing money, but they are already losing money by playing it safe. So what is risk really? And why do I say it's your friend? Let me break down the fundamentals. Risk in investment terms simply means uncertainty about returns. It does not automatically mean losing money. In fact, the proper definition of risk is the range of possible outcomes from an investment. There is a fundamental principle in finance. Higher risk comes with a potential for higher returns. Notice, I said potential, not guaranteed. This is crucial. Think of it like this. Low risk, low returns. Like bank savings accounts gives you 3 to 4%. Moderate risk, moderate returns. Like balanced mutual funds targeting 8 to 12% returns. And higher risk, higher potential returns. Like equity funds targeting 12 to 15% or more over the long term. There are 9 types of investment risk. Let me quickly walk you through the major risk every investor faces. Number 1, market risk. Overall market fluctuations affecting your investments is market risk. Number 2, inflation risk. Your money losing purchasing power over time. That is inflation risk. Number 3, interest risk. Changes in interest rates affecting bond values. That is interest risk. Number 4, liquidity risk. Not being able to sell your investment quickly. That is liquidity risk. Number 5, concentration risk. Having all your eggs in one basket. And number 6, credit or default risk. A company or government failing to repay debt. Number 7, business risk. A company's ability to generate profits. And number 8, currency risk. Exchange rate fluctuation for international investments. And number 9, longevity risk. Outliving your savings and investments is longevity risk. Here is the thing. You cannot eliminate risk. You can only choose which risk to take. Even keeping cash at home has risk. Theft risk or fire risk and inflation risk. The question is not should I take risk, but rather which risks am I being compensated for. Now, let me tell you why risk is actually your greatest ally in wealth creation. Reason 1. Risk creates opportunity. Every market downturn creates opportunities. When COVID hit in March 2020 and markets crashed 30 to 40%, panicked investors sold everything. But those who understood risk, they bought quality assets at discount prices. Those investors saw 80 to 100% return in just 18 months. It means risk rewards the patient and educated investor. Reason 2. Time transforms risk. Here is something magical. The longer your investment horizon, the less risky equity investments become. Over 1 year, stock markets are highly volatile. You might gain 30% or lose 20%. But over 15 to 20 years, equity markets have historically delivered positive returns in almost every rolling period. Time is the antidote to volatility. This is why young investors should embrace risk, while older investors near retirement should reduce it. Risk tolerance should match your time horizon. And the reason 3, risk teaches financial discipline. When you invest in assets with some volatility, you learn crucial skills. You develop emotional discipline. You understand market cycles. You learn to separate noise from real information. And you avoid panic selling and greed buying. These lessons make you a better, more mature investor. Reason 4. Risk beats inflation. The only investment that consistently beat inflation over the long term are those with some level of risk, primarily equities and real estate. If you want your wealth to grow in real terms, you must befriend risk. I know what you are thinking. This sounds great in theory, but I am terrified of losing my money. And that fear is natural. But let me show you how to manage risk intelligently. Understanding risk is one thing, managing it is another. Here are my battle tested strategies. Strategy 1. Know your risk tolerance. Ask yourself 3 questions. How long until I need this money? Which is time horizon. Number 2. Can I afford to see this investment lose value temporarily? This is risk capacity. Number 3. Will market downturns keep me up at night? That is emotional tolerance. Your risk tolerance is personal. It depends on your age, income stability, financial goals, and personality. There is no one size fits all approach. Strategy 2. Diversification is your shield. Never put all your money in one asset, one sector, or one investment type. You should not keep it spread across large cap, mid cap, and small cap equity funds, debt funds for stability, gold for inflation protection, and international funds for geographical diversification. When one asset class underperforms, others may compensate. Diversification does not eliminate risk, but it manages it beautifully. Strategy 3. Use systematic investment plans, SIPs. SIPs are the perfect risk management tool. Instead of investing a lump sum and worrying about market timing, you invest small amounts regularly. This averages out your purchase cost and removes emotional decision making. Like 10,000 per month is better than waiting to invest 1.2 lakhs once a year. You buy more units when markets are down and fewer when they are up, which is automatic risk management. Strategy 4. Match risk to goals. Different goals need different risk levels. Short-term goals, 1 to 3 years, such as for child's school fees, for vacation, use low-risk debt funds or liquid funds. Medium-term goals, which is 3 to 7 years, like you are purchasing your car, you will be doing home down payment. For that, you use balanced or hybrid funds. And the long-term goals, which is more than 7 years, that includes retirement, child's higher education. For that, you use equity-heavy portfolios. Strategy 5. Review and rebalance. Markets change and so should your portfolio. Review your investments every 6 months and rebalance if needed. If your equity allocation has grown too much, book some profits and shift to debt. If it's fallen, add more to maintain your target allocation. Before we wrap up, let me share the most controversial truth about risk. The biggest risk is not losing money in the market. The biggest risk is not investing at all. Every year you delay investing is a year of potential growth you will never get back. Every rupee sitting idle in a low interest account is a rupee losing value to inflation. Fear of risk keeps more people poor than actual investment losses ever will. Think about this. Over the last 20 years, Indian equity markets have generated 12 to 15% annual returns on average despite multiple crashes. 2008 financial crisis, COVID pandemic and countless political uncertainties. Meanwhile, those who played it safe with traditional savings have seen their wealth erode in real terms. Question for you. Are you willing to accept guaranteed loss of purchasing power because you are afraid of temporary volatility? Leave your answer in the comments. I genuinely want to know your perspective on this. Listen, I get it. Managing risk seems complicated and you might feel overwhelmed. That's exactly why I do what I do. Here is how I can help you. I work with individuals and families to create personalized investment plans that match your risk tolerance, your goals, and your life situation. I do not push products. I build relationships and provide ongoing guidance. If you are serious about making your money work harder for you, if you want a professional to help you navigate these decisions, I would love to chat. My contact details are in the description below. Let's schedule a free 30 minutes consultation where we will assess your financial goals, understand your risk profile, and create a customized investment roadmap. No pressure, no obligations, just honest advice from someone who has been in this industry for over 6 years. Before you go, if this video changed how you think about risk, hit that like button. It helps this content reach more people who need to hear this message. Subscribe to this channel if you want weekly insights on mutual funds, investment strategies, and market dynamics. I am committed to making financial education accessible to everyone. And share this video with one friend or family member who is scared of investing. You might just change their financial future. Remember, risk is not your enemy, ignorance is. Education and strategy turn risk into opportunity. I will see you in the next video. Until then, invest smart, stay disciplined, and keep learning.